Hello to all our friends and family out there in the financial advisory group world. Welcome to our third edition of an opportunity to sit down with Mary and pick her brain a little bit about a planning topic. This has become a very in-demand video that we do, and I think Mary doesn't brag too much about it here in the office, but by far our most watched videos are one that Mary's on. So Mary, thank you for joining us.
Absolutely. Happy to be here.
And before today, our topic will be the Trump accounts and sort of what are they, what purpose they could serve. And there's still a lot of unknown on them, but we'll get to that. But before we get to that, Mary, you want to provide us with a little update on some stuff going on here in the office?
Yeah, so the office is going through a facelift. We're going through a pretty big renovation right now, where in the last couple of years, we expanded to the downstairs of this building too. And so we're painting, new carpeting, new window treatments, really going through a whole new redesign. So over probably the next couple of months, if you visit us, we're not going to look like ourselves. But eventually it'll all come together. So right now, the upstairs is like getting spackled and doesn't look great. So pardon our appearance if you join us in the short term, but excited to see the outcome because the company has been here for 23 years, and this is the very first time there's really been any big changes to the design of the building. So looking forward to the outcome. And then we also have a new employee on board. Her name is Wendy. She'll be a client service associate. So between her, Kirsten, and Kathy, they have the service team filled. And stay tuned for a welcoming video from her on the next video. But I'm happy to have her on board. She literally just started on Friday, so you'll be hopefully meeting her at your next appointment.
Well, good that, yeah, a lot of fresh new additions here. And as Mary and I were sort of looking at some of the changes downstairs, it looks great. It's definitely different, but again, we love to call this place home. And just like home, every once in a while, you want to make a couple changes. And welcome to Wendy. Yes, part of the mandate is you got to make the 30-second to 1 minute video describing yourself. So that's coming. I promise that's coming.
Yeah. I
Um,
was fortunate when I got hired, there weren't any videos, so
yeah,
I
yeah,
did not have to film myself.
yes. The benefits of us being older, right? Yeah. Yeah. So I guess without further ado, we can jump into before I guess I pest you with some questions on it. You want to sort of walk us through sort of what is this Trump account thing we've heard about?
Yeah, so Trump accounts they're technically called 530A accounts.
Hmm.
So you've probably like a 401k, a 529, a 403B. These are technically, from the IRS's perspective, called a 530A account. But because they were put into legislation with the One Big Beautiful Bill Act under the Trump administration, they've been coined the Trump accounts. Um, and fundamentally, they're essentially a starter IRA for kids.
Hmm.
So, from the IRS perspective, they are coded as a retirement account,
Hmm.
but you can get them started as soon as your baby is born. This is the first year that they're being opened. So, as of July 4th, that's whenever they're going to start being opened and funded. And children born between January 1st of 2025 and December 31st of 2028, those kiddos will get $1,000 like seed from the Treasury. So if anybody is thinking about having kids, the next 2 years would be a good opportunity to do that to get the $1,000. And then you can contribute up to them. So right now there's a limit of 5,000 a year, and that can be made by the parents, the grandparents, employers actually, but up to 5,000 a year can be contributed to them. And the intention is it is basically a starter IRA for kids, um, geared towards basically funding a retirement account for 65 years. And the benefit to them is you don't need earned income, which we'll get into the details of that later, but you can make contributions until they're 18. So once they turn 18, that's kind of a pivotal year. So you have to stop making contributions and you can't take any distributions until they're 18. So 18 moving forward, there is the ability to take distributions. But yeah, that's pretty much the Trump account in a nutshell. And in order to get the $1,000 funding from the Treasury, you do have to. There was a form with your tax form, or there was a form with taxes this year you should have filled out in order to automatically be enrolled in these accounts. But if you didn't, no worries. You would just go to there's a website, trumpaccounts.gov, and you would basically, after the fact, fill out this form And then from our understanding, automatically on July 4th, those accounts will be opened and the $1,000 will be added from the treasury. And then parents, family members, you can begin your contributions at that point.
And I think as Mary and I were talking about this, correct me if I'm wrong, Mary, there's a lot of ambiguity around this, right? Because technically these doesn't even exist yet.
Yes.
So a lot of this take with a grain of salt, right? Like the open on July 4th, that's assuming this is all ready to go.
Yep.
One sort of off the beaten path question you'd mentioned on your tax return. That
Mhm.
would be on the parent's tax return, right? Because they're acknowledging they have a kid. It's not
Yeah.
so as a grandparent level, as a lot of clients want to fund, it wouldn't be their taxes they'd see it on. It would be their kids or the
Yeah.
grandkid. Yep.
Yep. So it would be whoever the child with the social security number
Yep.
is on. It would be that individual's tax return.
Okay.
Usually the parent.
Yep.
Um, yep.
And you mentioned that age 18 as sort of being an important number. So right? I put in the account. Unfortunately, my kiddos are a little too old. They're both over
Yeah.
18, but Keenan turned 18 this year. So what happens like when Keenan turns 18 or when Leon turns 18?
Yep.
What happens at that point?
So nothing can happen, theoretically. It can essentially stay in this 530A or Trump account in forever,
Okay.
and then be held until retirement. There are some planning opportunities to convert it to Roth, and then it essentially converts from this traditional-ish IRA into a Roth IRA, which
Hmm.
then continue to grow until retirement. There are options around funding education, funding a home purchase, the start of a business, but ultimately, from a fundamental level, it is geared towards retirement. So doing nothing, it stays as a traditional IRA with some quirky tax loopholes, or you can then convert it into a Roth IRA at some point.
Okay. And then we won't get into the details, but if you do convert it to a Roth, there's some tax implications to doing that as well.
Yeah,
Yep.
there's two pieces to the money that would then be in this Trump account. There's your contributions that you made, and then there's any growth on those contributions. So the contributions that you make throughout the course of the 18 theoretical years, there's no immediate tax benefit. So you're not getting a tax write-off for making the contribution. So if you put in $1,000, you can at 18 get that $18,000 out tax free. But if there's $1,000 of growth attached to that account now, you have to pay tax on that growth. So whether you take that money out and pay it to yourself or do the conversion into a Roth IRA, you do have to pay tax on the growth that's associated with the account.
Okay. And then I guess the whole the couple little loopholes, like the $10,000 for first time home purchase, that is something that as of now, again, is allowed.
That is. So there's no way around paying tax on the growth, but there
Okay.
are certain circumstances. Paying for education is one of them, taking to up to $10,000 out if you're purchasing your first home, that you can access those funds without paying a penalty,
Gotcha.
but you still have to pay tax on the growth in the account. And
So
that's taxed as ordinary income to the
Mhm.
beneficiary.
Which again, we'll come back to that in a little bit. Like ordinary income's sometimes not the most friendly place to be taxed.
Right.
But that's interesting. So the withdrawals are approved, but they're only approved without the 10% penalty, not a waiver in the tax liability.
Yes, as of now,
Okay.
I could not find any
Yeah.
circumstance where you can get around the taxes.
Yeah. People will be looking. People will be looking. Um,
Definitely.
And I guess to sort of compare this, there's a lot of different. Does this differ from if you take it in whichever order, the 529 account, which is already out there, and then the UTMA account? Do you want to walk us through sort of those three vehicles, sort of what you see as the differences?
Yeah. So a 529, I'll start with that because that's what most people are familiar with. That is geared towards education. So that's from an IRS perspective, coded as an account for education. Um, so if you make contributions into that, again, similar to the Trump account, no immediate tax benefit. You get the tax deferred growth on it. And then if and when the time comes for college, you spend that all on college, it's tax free. Um, so that is an education geared towards education. The UTMA is more so geared towards like multi-use. If you want to basically do anything with it, you can spend it on education. You can spend it on buying a new car, new house, anything to kind of enhance the beneficiary's life. As long as it's being spent on that person, you can spend it. There's really no tax benefit to the UTMA other
Yeah.
than like it's called a kiddie tax. So there's some amount of tax benefit, but not as significant as the 529. So that's really not geared towards anything specific. Just as long as it's enhancing the beneficiary's life, you can spend those funds. And then the Trump account, the 530As, that's really geared towards retirement, but can be used for other purposes too. Again, no tax benefit to doing it, but you can avoid penalties in some fashion.
Okay, so again, from our perspective, right, from if education is the primary goal, I'll go back to my boys, right, Liam and Keenan in college. The 529 still seems pretty extraordinary with the fact that you
Mhm.
get the tax deferred. But like we said, I think Mary and I, as we talked about it, it's like a kid's retirement account. As we keep coming back, as we sort of pick through all these questions, we're picking with Mary. And I guess thinking that through, then what's the difference in this? You can open up a custodial Roth IRA where I, as a parent, can have an IRA for Keenan or Liam while they're not, while they're still a minor. Is there a difference between those and what the Trump accounts are?
Yeah, the biggest difference is to fund a custodial Roth IRA, you need to have earned income.
Yep.
So that's usually when somebody is 2 months old, they're not working, so they have no
Leon's
income.
not Leon's not working yet?
No, he's not. um, so they, with the Trump accounts, you can fund up to that $5,000 as
Hmm.
soon as they're born per year, with or without any earned income. The Roth IRAs require some level of income. So those usually, I mean, depending on how ambitious your child is, if they start mowing lawns when they're 12 years old, then they can theoretically fund a Roth. But most custodial Roth accounts can't really be funded until the child is 15 or 16. Whereas the Trump account, because they don't have that in place where you need the earned income, you can start that as soon as they're born. So a big difference there. That's one of the main differences in
Yeah,
the
it's
two.
definitely a pretty substantial. Yeah, that tends to be a hurdle trying to get money aside for the kids.
Mhm.
And I guess before we get into sort of some final closing thoughts, how about like the investment part of this, right? I put the money in, where does it go?
So it is very restricted right
Hmm.
now. And in fact, everything is done through the Treasury Department as far as filing the tax form, getting the accounts opened. And then right now, the only like broker dealer that can open the accounts and fund them is BNY. And there are very tight restrictions on what the account can be invested in. Right now, it's strictly the S&P 500, which ultimately, if this is a retirement account, you should be taking maximum amount of risk in it. But depending
Hmm.
on how you plan to spend it, that might not be the case. So very restricted from an investment standpoint. BNY right now is the only relationship that the Treasury has. So not something right now that we can help with. We can direct you and give guidance, but not something that we can actually open and fund for our clients.
Okay, that's super helpful. So I think it's another account that's out there, right? That we have an option, which almost complicates things more.
Yes, it
Um, but I think,
does.
right, as we've talked this through, do you think it's safe to oversimplify this whole picture, right? The 529 still looks like the best vehicle to use if talking about funding education.
Yep.
Plus, there's some ability in there to do some Roth conversions, right? It's a pretty cool concept.
Yep.
The UTMA account, more flexible, right? Not as much tax friendliness to it, but a lot of flexibility to how you can use it, where we
Mhm.
really see as the TAs or the Trump accounts more as retirement vehicles for kids. Is that sort of
Exactly.
a
Yeah.
simple? Okay, okay.
Yep, yep.
Um,
A lot of articles, they're considering them starter IRAs for kids,
yep.
is kind of what they level them as.
Trying to help out our kiddos even more, you know?
Yeah.
Um, and I guess thinking through those lines, right? The one thing when we think about this is sort of what could this end up looking like? We just did a quick illustration here of sort of, what could this look like if you funded a Trump account for someone starting at we'll use Leon as our example, right? That Leon was born in 2025. Mary strategically had Leon born when these were created. Um, so the way the Trump accounts work is the government would put in $1,000 if you applied for it. Plus, we made an example where we'll use Mary and Luke as our example that they put in $1,000 a year then for the first 18 years of Leon's life, and said, what if this grows at 7%? Because I think Mary hinted out there that you can only invest in the S&P. So we're assuming a 7% rate of return. At Leon's age 18, there'd be close to $40,000 in the account. 18 of or 19 of that being contribution, right? One from the government, 18 from Luke and Mary, to a balance of about $39,000, a gain of $21,000, which is fantastic.
Mhm.
The power, though, in here is the compounding effect of this. What if then Luke and Mary don't need this for Leon, then, which is the whole idea of these? They stop making contributions and it just sits in there all the way to Leon's age 60. That $19,000 total contribution grows up to almost $700,000. Fantastic, right?
Mhm.
As you see the title of the slide, though, the power is compounding, the cost is taxes. The downside now, right, is that of that $700,000, let's to round it to that figure, 19,000 is contribution. The other 600 plus $1,000 is all taxable. Mary, am I right? At ordinary income
Yep. As of now.
as of now. So
Mhm.
it's a fantastic vehicle. The cost is the tax impact of it down the road. And there are some, like we talked about, you can convert these to Roths, which again, there's some
Yep.
tax considerations. We don't want to get into
Yep.
too much of minutia. Um, but I guess with that, any quick summary thoughts of this, Mary, as you dive into another complex sort of planning vehicle that's out there for you, sort of what you see or what your use case would be?
The use case would be if somebody is already confident in the 529 contributions that they're making, so they already have college funded, or college isn't a priority of theirs to fund. Grandparents, I think, always want to help out. So if I'm already funding college, but my parents want to do something for Leon, this could be a good use case to make those contributions. But yeah, just another account out there adds a little bit of complexity to options, but it serves a purpose for some people. But ultimately, there's already accounts that exist for a lot of the purposes that it serves.
Yeah. Okay. Well, thank you. That was super informative. And I think as we're all sort of waiting, it's interesting that July 4th is when these go live.
Yeah.
Like everything that the government does, just hold your breath, right? We'll see how this plays out. And
Yep.
it's interesting, like Mary said, and I know we may get this question is, can someone call into here and open a Trump account? Not yet. I'm not sure if you ever will be able to. It all has to be done through the government, which might give you some comfort, might not give you some comfort, right?
Yeah.
So we'll see how that goes. Um, but excellent, Mary. Thank you for taking the time to talk us through these. As we find out
You're
more, obviously,
welcome.
we'll talk about these in meetings. If
Mhm.
you have questions, concerns, let us know. We'll hope to pull Mary back in for another couple of these planning discussions in the future. But other than that, looking forward to seeing everyone here in the office and what it will look like a little bit differently. And then we'll send some introduction out on Wendy some in the next couple of weeks as well. But thank you as always for all the trust and confidence you place in us. Thank you, Mary, for the time.
Mhm.
And we hope everyone has a fantastic rest of the spring. It looks like the weather is finally settling into what we want.